So if you're 65 plus, you are automatically eligible to get $7,600 added to your standard deduction, and that's per taxpayer.
I think there's a key detail there too, is that you don't have to be taking Social Security to qualify for the extra deduction, correct? The tax code is written in pencil, as they say. Welcome everyone to Connecting the Dollars. I'm Amanda Vaught here with Emily Agosto. We're continuing our series on tax law changes enacted under the One Big Beautiful Bill Act, which we refer to as OB3. Today, we're going to talk about the senior deduction, sometimes advertised as no tax on Social Security, which is not the case. What is the case is a deduction if you're 65 or older, which is what we're going to discuss today. So can you tell us some details about this new provision, Emily?
Yes. So as Amanda said, it's acting as the replacement for the no tax on Social Security promise or intention that you might have heard from Congress and whatnot. So if you turn 65 in 2025, you are eligible for an extra $6,000 standard deduction. And that's in addition to the already existing $1,600 extra standard deduction for seniors. So if you're 65 plus, you are automatically eligible to get $7,600 added to your standard deduction, and that's per taxpayer. So if you're married filing jointly, both individuals are 65, they will get an extra $1,500 added to their standard deduction. And there is a phase out for this extra standard deduction. Single filers, if you make between $75,000 and $175,000, this extra deduction will be phased out. For married filing jointly, the AGI between $150,000 and $250,000 is aged out. If you are married filing separately, you are not eligible for this extra temporary senior deduction.
I think there's a key detail there too, is that you don't have to be taking Social Security to qualify for the extra deduction, correct?
Right. And that income range I mentioned, the 75 to 175 and the 150 to 250, that's any source of income. It's not just Social Security income.
And so this, I think for people age 65 and up that qualify for this, some are retired and not working, and plenty of people are still working at age 65. And so what could be impacted here is your tax return, but also your withholding may or may not need to be adjusted to account for this new.
Yep. If you're still getting a W-2 and you're withholding at your regular rate for your income, that's probably going to result in a refund. If you in the past have regularly gotten refunds, probably a higher refund. I'll say that. But yeah, it's a little bonus for people ages 65 plus. So I think it's a pretty good deal.
Yeah. One day we'll get it, Emily. But it's phasing out. So by the time I'm 65, who knows what the tax law will be. That's our favorite thing. The tax code is written in pencil, as they say.
Yes. So we'll see where this goes.
Yeah. And that's our series on OB3. We covered the new senior deduction, no tax on tips or overtime. You still pay tax on it, just no income tax, and the SALT cap. I mean, a few other little things changed, right? The child tax credit, anything else?
A couple of things I can point out. The child tax credit increased from $2,000 to $2,200. The state tax exemption was $15 million beginning in 26, so that doesn't affect 25. The repeal of the energy credits, the clean vehicle credit, the energy efficient home improvement and residential clean energy credit have expired or will be expiring at the end of 2025. The alternative fuel vehicle refueling property credit, that's a big one, it's a mouthful. The energy efficient commercial building deduction and new energy efficient home credits are available until June 30th of 2026. So plan accordingly if any of those apply to you.
And then charitable deductions are changing.
Yes, the charitable deductions are now going to be subject to a 0.5% floor starting in 2026. For 2025, nothing's changing. So if you are someone who typically itemizes your deductions and does not take the standard deduction and you give a lot to charity, keep an eye out for changes to 2026. And it might make sense to maybe bunching is what it's called. Typically do your 2026 and 2027 deductions in 1 year if you can, to be able to take more of that. So there's a little more planning that goes into it, a little more potential strategy. Not a huge change, but something to be aware of.
Yeah. Whenever they update the tax code, they love to introduce these new complexities. Somehow, it's never simpler, feels.
Got to keep us on our toes.
We hope that was helpful, and we'll link to our other videos in our series in the notes.
Thank you.